Hello, guys. Welcome to episode 6 of 10-Minute Bookkeeping. Today, we're diving deep into the world of long-term assets, the workhorses that keep running for an entity. We'll be focusing on plant assets and intangible assets, understanding what they are, and more importantly, how to handle them throughout their entire life cycle. From the moment these assets join the entity, to their day-to-day contributions to operations, and even when it's time to say goodbye, it will be all covered. By the end of this episode, you'll be a pro when it comes to managing these assets. So, fasten your seatbelts and get ready for the fun learning and discovery. Plant assets, also known as property, plant, and equipment, or abbreviated as PPE, are tangible assets meant for long-term use. They typically include equipment, buildings, and land. Two key things distinguish plant assets from other assets. Firstly, they are tangible assets used for business operations. For instance, when a company buys computers, those held for sale are called inventories, while those used by employees are termed plant assets. Secondly, plant assets have useful lifespans exceeding 1 year, so items like pens and paper aren't considered plant assets. Instead, they're categorized as supplies due to their short usage life. According to the cost principle, we measure an asset at its cost when it's acquired. But here we take it up to a notch. What really matters is the total cost of the asset. It's not just about the purchase price. It includes everything needed to make that asset fully operational. Let's apply this to the acquisition of plant assets. There are two primary ways to acquire plant assets. First, there's the purchase route. Take, for example, Beacon Company. It bought a computer system for $20,000, but the story didn't end there. Beacon Company also paid $200 for shipping and $2,000 for installation. The actual cost of the computer system was more than the purchase price. We would record the computer system at $22,200. Another option is self-construction. Beacon Company, in this case, constructed a new building for its operations. It invested $800,000 in materials, paid $2 million in salaries to workers, and spent $700,000 on services. Now, why don't you pause the video and try to record this transaction? Let's figure this out together. When you add it all up, the total cost of the building reached $3,500,000, and then we record the acquisition like this. The bottom line is that whether you're buying or building, it's all about that grand total. The cost of a plant asset isn't just the price you see. It's everything it takes to make it a reality. Plant assets keep running for an entity, but except for land, they don't last forever. Over time, these assets get consumed, wear out, and eventually become useless. This slow transformation is what we term depreciation. Think of it as savoring a giant juicy hamburger. You don't swallow it all at once. You chew through it bit by bit. But how do we calculate the size of each bite or the depreciated amount? Well, it involves educated guesses. First, we estimate the plant asset's service life, which means how long it's expected to remain useful, and its residual value, which means how much it's worth at the end of its life. Now, we have to pick a method for our estimations. For simplicity's sake, we'll stick to the straight-line depreciation method in this course. It works like this. We take the cost, subtract the residual value, and divide the remaining portion by the service life. This gives us our bite size. There's another thing to note. Instead of directly reducing the asset's value, we use a special account called accumulated depreciation to keep track of those bites. Every time a bite of the hamburger is taken, we add a little more to this account. And here's the trick. A decrease in the asset's value is always recorded as a credit, which means the accumulated depreciation account grows on the credit side. Now, equipped with this knowledge, let's apply it to a practical example. Consider Beacon Company, which acquired a piece of equipment on September 30th for $25,000. This equipment was expected to last 24 months and had a residual value of $1,000. Let's assume Beacon prepares financial statements monthly. Your mission is to record the acquisition and depreciation for 3 months. Now pause the video and give it a shot. Welcome back. Let's break it down together. On September 30th, we debit the equipment and credit cash. The monthly depreciated amount is $1,000, indicating that the company consumed $1,000 worth of the asset each month. We know that when there's consumption, we must recognize an expense, which in this case is depreciation expense. So every month, we debit depreciation expense by $1,000 and credit accumulated depreciation by the same amount. The difference between the asset's original cost and the accumulated depreciation is called the book value. Think of it as the part of the hamburger that remains uneaten. These values, including cost, accumulated depreciation, and book value, are all presented on the balance sheet, providing readers with a clearer picture of the asset's original cost and how much has been consumed over time. Handling the disposal of a plant asset is a bit like tidying a house. First, you remove its cost and the accumulated depreciation from the accounts, just as you'd clean out old items. If you get something in return for the asset, you record it, similar to finding something valuable while cleaning. Then comes the twist. The book value of a plant asset often depends on estimates, and there might be a difference between what you actually get and the estimated book value. When this happens, we recognize it as a gain or a loss on the disposal of plant assets. For example, a company had an asset that initially cost $40,000, had accumulated $30,000 in depreciation, and managed to sell it for $12,000. The book value would be $10,000, resulting in a gain of $2,000 from the sale. Now, it's time for you to record the transaction in a journal entry. All right, here's how we record the transaction. Did you nail it? Now it's time to move on to the next section, intangible assets. Intangible assets may not have a physical form, but they hold significant value for an entity, much like plant assets. Intangible assets are used for operational purposes and have a useful life of more than 1 year. Common examples include patents, trademarks, copyrights, and goodwill. Now, let's explore the complete life cycle of an intangible asset, covering its acquisition, utilization, and disposal. 1. Acquisition. Intangible assets are initially recorded at their cost. It's essential to note that there's only one way to acquire an intangible asset, and that's through purchase. Intangible assets don't exist on the books until they've been bought. For example, if one company reports $1 million in trademarks and another reports nothing, it doesn't mean one has trademarks while the other doesn't. It simply means one has purchased trademarks and the other hasn't. 2. Utilization. Some intangible assets have a limited lifespan. In such cases, you spread the cost over their expected life, a process called amortization. To keep track of this, we use the accumulated amortization account. Unlike plant assets, intangible assets typically don't have a residual value. The amortized amount is determined based on the asset's cost and useful life. And the straight-line method is usually used for estimating amortized amounts. 3. Disposal. When it's time to dispose of an intangible asset, you remove its cost and accumulated amortization. If you receive something in return during the disposal, you record it. Any difference in value is recognized as either a gain or a loss. Now let's put this knowledge into practice. Consider Core Company, which bought a patent for $6,000 on January 6, 2022, with a lifespan of 3 years. It sold the patent on June 30, 2023 for $2,000. Assuming the company prepares financial statements once a year, how should these transactions be recorded? Take a moment to pause the video and give it a try. Welcome back. Let's walk through this together. On January 6, 2022, when Core Company acquired the patent, we debit patent and credit cash for $6,000. The annual amortization amount was $2,000. And by the end of 2022, an amortization expense of $2,000 should be recognized, with an increase in accumulated amortization by the same amount. On June 30th, 2023, when the patent was sold, we first need to recognize the amortization for half a year. which amounted to $1,000. Now, we can calculate the book value of the patent on June 30th, which would be $3,000. Since the patent was sold for $2,000, a loss of $1,000 should be recognized. And here's how we record this disposal transaction. Congratulations! You've unlocked the secrets of accounting for long-term operational assets. Keep practicing. In our next episode, we'll explore how entities raise funds. Stay tuned and see you there.